You know, there are a lot of considerations when deciding when to sell a house. Like, is there such a thing as selling a house too soon? Or aren't there tax benefits if I hold on to it for a certain period of time? Is that just if I am living in it myself, if it's an investment property? To most people, a house is really just a home. But did you know that there are hidden benefits to holding property for certain periods of time? You know me as a real estate investor, and there's a lot of people who are like, oh yeah, Kris is just holding on to a home forever because someday the tenants will get it paid off. And that's also not true. There's a time to buy a house, there's a time to hold a house, and there's a time to sell a house. And you know what? If you want to make as much money as possible, knowing when to sell the house actually matters.
Wow.
To most people out there, real estate is a place that you live in. It's for you, it's for your family. And then when you're done with it, you move on. Your job might take you different places. You might get relocated. You might downsize because you've been living in the house for a certain period of time. But there is, in fact, strategy on when to sell a house. And I'm talking about, yes, making maximum dollars, but I'm also talking about maximum tax benefits. And not a lot of people understand that there's a way to maximize your investment on knowing when to sell. So in today's video, we're gonna talk about when to actually sell a home and when not to. All right, let's set the record straight. If you bought a house, you can sell a house anytime you want. But for just a moment, I want you to think about cars. Like, you realize that it's actually a depreciating asset, as in like, well, I buy a new car and I drive it off the lot and then I lose like 20% of its value. Like, wow, like I would not want to sell my brand new car tomorrow because I might take a loss of thousands or even over $10,000. Real estate is not nearly as brutal as cars because they're not liabilities. They're actually investments. They go up in value. For example, let's just consider this one really powerful thought. Much like a car, if you buy a house today, look at all the costs that you incur just at the moment it gets bought. It's like, if you wanted to turn around and sell it the next day, guess what? You'd have to pay closing costs. You might have a prepayment penalty on your loan. You also have to pay realtor fees. And when you start adding it up, it's like, whoa, whoa, whoa. Realtor fees are like, let's call it 6%. It's like on a $400,000 house, that's $24,000. Like, I would be upside down underwater if I tried to sell my house too quickly. Looks like I might need to hold it for at least a minimal period of time before I can recuperate some of those costs and even get to a break even. And you're right, there is truth in that. In other words, there's a minimum amount of time that you really want to hold a home to make sure you don't lose money. And conventional wisdom does say the longer you hold a home, over time, the more money you make. Let's start with a pro tip on today's video of always holding a home for at least 2 years. Well, let's talk about what happens to real estate in 2 years. First of all, you understand that when you buy real estate, it traditionally appreciates in value and does not depreciate. Depreciation can occur, but if you look at the next decade, we're missing 7.2 million single-family homes. So if we're talking about a single-family home, there is a reason year over year over year why they keep going up in value. So you can Google your market and ask, what's the appreciation in my area? And let's say it's 5%. Here's what that means. Your $300,000 home, on average, is going to increase 5% that year. 5% of $300,000 is $15,000. So when I say hold it for at least 2 years, why? Well, let's just say that you're getting 5% in the first year and 5% in the second year. And let's just assume that that's on $300,000, 15 grand in the first year and roughly 15 grand in the second year. That's a $30,000 increase. That $30,000 increase is important for a couple of reasons. The first one is when you go to sell a house, you have selling costs, and on average, your closing costs are $7,000. But on top of that, if you're covering some of those realtor fees, and let's say they're another $15,000, we'll have $15,000 in realtor fees, I got $7,000 in closing costs. I'm already at $22,000, and during those 2 years, I appreciated $30,000. Like, I think I'm at a break even. I might be at a break even. I might not be at that break even. It's like, well, wait at least 2 years just to catch your breath and have a shot at break even. There's also a really important tax implication for why you would want to wait a minimum of 2 years. The rule still exists today that did 20 years ago when I bought my very first house, which basically says if you live in a house for 2 out of 5 years, when you do go to sell it, you're able to write off the capital gains. In other words, you don't have to pay them. You know, like capital gains, what does that mean? Go back to our example. This house is appreciating at 5% on a $300,000 house, which is approximately $15,000 in the first year, $15,000 in the second year. That's $30,000. After 2 years, I choose to sell the house. And guess what? I had to pay my realtor fees, I had to pay my closing costs, but there was also a gain on the property. And let's say it was a $30,000 gain. You would owe the government some money on that, but because you lived in it for the last 2 of the 5 years, you owe nothing. You don't have to pay any taxes, which is why when my wife and I bought our very first house, we challenged ourselves, even though the house was small, it was kind of cramped, it was definitely old, we challenged ourselves to live in that house for the first 2 years just to take advantage of that tax benefit. And can I tell you, because we bought the house $40,000 below market, we walked into it from day one with $40,000 of a capital gain. But on top of that, the house went up in value more. By the time we sold it, it was $65,000 of increase. We didn't have to pay any taxes on that $65,000 because we lived in it for 2 of the last 5 years. Now there is a caveat. Owning and living in a home for 2 years can qualify you for this IRS principal residence exclusion. This allows you to deduct up to $250,000 in sale proceeds if you're single and up to $500,000 if you're married and filing jointly. So there are limitations on this rule. So it kind of begs the question, how short should I wait before selling? Let's ask the opposite question. How long should you wait? I'm going to tell you right now that profit is king. And to avoid losing money, the longer you hold the home, the more money you're actually going to make. We've all heard of people, shoot, you probably grew up in a home with parents or had neighbors who were like, oh yeah, we bought this home when we were young and then we sold it 20 years later and we made like $400,000 on it. They made all that money on that gain because the longer they held it, the more it appreciated in value. Like the very first house I bought was built in the late 40s for $5,000. Now, I bought that house for $110,000 when it was worth $150,000. It's like, what happens? Well, we understand there's this thing called inflation, right? And it's the devaluing of the dollar. And on the 100-year average, you lose 3% of the value of your bank account every single year. And lately, it's been closer to like 4.1%, which means here is $100,000. And if inflation is averaging 3%, then I'm losing $3,000. Like taking $3,000 of my 100 grand and like dipping it in kerosene, lighting a fire, putting it in the toilet, flushing it down the drain, the money is gone. You're never gonna see it ever again. But that's what happens to soft assets like 401ks, IRAs, money in a savings account, actual cash, crypto, things like that. Money that is sitting in a physical, tangible asset, I can touch it, I can lick it, like this is my house, the opposite occurs. It doesn't lose 3%, it usually does the inverse and it gains, which is kind of one of the secrets why most millionaires, like 90% of them, all own real estate. It's like, don't stash your cash in the bank, stash it in a property. And when you do that, it actually goes up in value every year instead of your money going down in value. So Kris, if you've transacted over 6,000 single family homes, are they all paid off? Well, here's the funny thing. I actually don't like paid off real estate. You see, I don't own a home and hold it for 2 years and sell it because profit is king the longer you hold on to it. Well, something happens to the other side of the curve the longer you hold a property. You actually can produce, after 7 to 10 years, a diminishing return. For me, as an investor that loves to buy and hold properties, I normally hang on to them for 5, 6, or 7 years. After that period of time, I sell them. I take all of my profits. I don't pay taxes on them. Remember, I didn't live in that home. It's an investment property. I'm using a different tax exemption. It's called the 1031 exchange. And it basically is where I'm saying, well, I originally put this money in this property and then it produced profits like that. And if I sell it, I'm gonna have to pay taxes on my gains. Or I could just literally sell the property, find more properties, transfer all my money into it. And it's like, now I have not one home, imagine 2 or 3 homes here. My portfolio has multiplied and I still didn't have to pay any of those pesky taxes. Why? Because I just transferred my gains into more real estate. But Kris, why would someone do that? Like, don't you want to like spend your money? It's like, if I have 2 homes and it tastes good because I get positive cash flow on 2 homes, then I promise you 10 homes taste better. And if you have 100 homes, then you start picking up a very meaningful amount of positive cash flow. So much so that it actually starts paying for like the rest of my life. But all that cash flow is also tax-free because I also have this thing called depreciation. That's the IRS's other rule where I get to write off a property over 27 and a half years. And when you take the value of the real estate you buy and you divide it by 27 and a half, whatever that number is always way bigger than your positive cash flow, which means all the money I'm making off of this thing I don't have to pay taxes on, and then later I'm gonna sell it, multiply my portfolio and get more cash flow, but I don't have to pay tax on any of that. It's a beautiful thing. So bottom line, when you buy real estate, plan on holding it for at least 2 years. Don't forget the 2-year IRS tax exemption that if you live there, you don't have to pay taxes. If you don't live there, then make sure that you transfer that through the 1031 exchange into a lot more property, and then through depreciation, you don't even have to pay taxes on your positive cash flow. And there's exceptions to every single rule, and you might be wondering, are you the exception? What would I do in your situation? Well, how about I tell you for free? It's actually called a free game plan. Like, click the link below and say, I want to know what Kris would do if he was in my financial situation. Because here's the reality. You want to build a portfolio. You don't want to trade a house that you live in for another house that you live in, for another house that you live in, and then retire with literally one house. What you want instead is to have a plethora of homes. Bottom line, click the link below, request a free game plan, and let me show you how to take the equity in your home and multiply it. Let me show you how to use that pesky 401k or IRA that's never going to amount to enough for retirement. Let me show you how to put that into the game of real estate. Bottom line is, whether you just want to be financially free or you just want to make a smart real estate move, click the link below and get some free advice from a multimillionaire. Me or one of my certified coaches are going to reach out. We're going to share with you, what would Kris do? And you know what? It's maybe what you shouldn't do, but it is what I would do. And what I do is yummy. Kris, did you say that your goal is not to pay off your real estate? No. There's actually 3 reasons to never pay off your home. And I do, in fact, mean your personal residence if possible. And I recognize that I might be the first person that has actually ever told you not to pay off your home. And right now you're probably looking at me like I'm looking at you. But I'm telling you, if you're trying to pay off your home, you're crazy. And if you want to know why I maybe think that about you, I want you to click right here and watch this video. Let me save you.